policy. The monetary policy, or known as financial policy, refers to a policy which employs the central bank's control of the supply of money as an instrument for achieving the objective of the general economic policy. Monetary policy may aim to achieve the optimum level of employment and output, price stability, balance of payment equilibrium, or other goals of the government's economic policy with the regulation by the central bank. Central bank influence the cost of credit primarily by affecting the cash reserve of commercial bank in the economy.
Overnight policy rate, OPR. OPR is an overnight interest rate set by our central bank, Bank Negara Malaysia (BNM), that determines the rate of interest for financial institutions that lend each other money overnight. Bank interest rates defined by OPR provide the framework for monetary direction on a national level that ensures banks have a stable supply of available cash. Because the OPR is so fundamental to the workings of our banking system, changes to the OPR rate often have a dominant effect on a range of other economic factors beyond simply lending rates. For example, employment and inflation on the cost of goods.
BNM raised the OPR rate to curb inflation. The increased OPR will also indirectly strengthen the value of the ringgit. It is a move by the central bank in redeveloping the country's economic growth. Like other central banks around the world, BNM raised the OPR to manage the risks of price increases. A higher OPR helps control the risk of inflation caused by excessive borrowing and spending. OPR increases discourage spending when borrowing costs are higher for floating rate loans only. The increase in OPR encourages savings with higher deposit rates.
Increased monthly installment payments. Whenever the OPR goes up, banks will pass on the higher borrowing cost in the form of a higher interest rate to consumers, which in turn increases the amount of your monthly installment payments. Secondly, loan tenure will increase if the monthly installment amount is maintained. If the old monthly installment sum is maintained, the repayment period will become longer due to the increase in interest rate. They say, while the higher OPR work costs households to reduce consumption to cover increased loan repayments, and the higher the cost of living, prices of goods would gradually fall, thus reducing inflation. Lastly, the higher the OPR is set, the more expensive it is to borrow money. The more expensive it is to borrow money, the more limited the affordability of accessing capital becomes for both personal and commercial purposes. If it costs more to lend, less people can do it. That can have a notable impact on the housing sector.
Impact on firms. The higher the OPR is set, the higher the cost of borrowing would be. This will lead to fairer capital financing opportunities, as banks will tighten the prerequisite requirements for both individual and businesses to secure loans. The OPR will help to slow demand down. This brings demand more in line with supply, and price will increase more slowly.
As a conclusion, generally when the OPR rises, local consumers and traders will suffer a little in the short term, but in the long term, the attraction of foreign investors into Malaysia will further strengthen our economic position in the future. So, increasing OPR or decreasing OPR always have pros and cons.